Chaos absolutely hit the markets over the weekend, and this started with President Trump announcing that there was going to be tariffs on goods coming into the US from Canada, Mexico, and China. I'm going to get to that in just a second. But really what we need to think about is what the market is reacting to. And it's really about uncertainty today, and uncertainty as to how long these tariffs are going to last, how big they're going to be, what kind of retaliatory tariffs are going to be put in place, what's the impact on earnings. All of these things become more uncertain. And what investors are looking for is certainty in the returns that they are paying for. The other piece of this is that the stock market in particular is at very, very high valuations. I'll show you a chart in a second, but the PE multiple of the S&P 500 is higher than it's ever been in a non-recession period. That's telling you that there's a lot of optimism priced into the market already. So when you combine optimism with uncertainty, that leads to a kind of crash that we're seeing right now. I'm recording this late on Sunday, so I don't know yet how things are going to open on Monday. But as it's looking right now, the market is going to be down over 2%, could be even more than that. And there's going to be some likely pain points depending on where prices go. I'm going to give an early preview of this. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you want more from me, check out Asymmetric Investing, my newsletters. There's a link on the screen and then a link below. You can get my weekly market commentary, including my cautions about exactly this kind of event happening, the recent short position that I put on to hedge against this kind of risk, and everything that I'm doing with my portfolio, including my buys for February, which will be coming out on Monday morning. I'm going to be back in just a second with the latest on what's going on in the market after this word from public.com. All right, if you are serious about investing, you need to know about public.com. That's where you can invest in everything from stocks to options, bonds, and even crypto. They even offer some of the highest yields in the industry, like the bond accounts, 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools that you need to make informed investment decisions. Like their built-in AI called Alpha, it doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Now, Public is a FINRA registered, SIPC insured, US-based company with customer support teams that actually care. The bottom line, your investments deserve a platform that takes them as seriously as you do. You can fund an account in 5 minutes or less at public.com/ASYM and get up to $10,000 when you transfer in an old portfolio. That's public.com/ASYM. This ad was paid for by Public Investing. Full disclosure is in the video description. Let's start with the scale of what's going on right now. And like I said, this is late on Sunday. Right now, the NASDAQ 100 futures down 2.7%. That would actually eat up almost all of the gains, potentially all of the gains that the NASDAQ 100 has so far in 2025. So we could be down to flat on the year as early as the open on Monday morning. You can see a similar story playing out with the S&P 500 futures. This is where we were at the start of the year, about 59.16, almost down to that point after a 2.1% drop. And what I think is ultimately the most worrying is the crypto market, which is the one market that's traded 24/7, just absolutely got decimated. And this happened about a couple of hours ago as I'm recording. In the last 24 hours, Ethereum's down 18%, XRP down almost 20%. You go down to smaller tokens, Cardano's down 24%, Chainlink almost 20%. So these are massive, massive moves from multi-billion-dollar assets. And this is the thing I think we need to start with, because there's a lot of unknowns about exactly what's going on with tariffs, what the impact is going to be. But when your starting point is a very, very high price to earnings multiple, that means that the risk is really to the downside. So not only do you have uncertainty, multiple compression could actually play a massive role in the drop of assets over the next day, week, month, maybe even year or more. At the same time, multiple expansion has actually been what's been driving the market since 2011. So let's just go through some of these numbers. Right now, we are at a 30.2 price to earnings multiple. This is according to multiple.com. There have only been a couple of points throughout history, and this chart goes back to the 1800s, 1871. There have only been a couple of points throughout history that the multiple has been this high. The first time was in 1998-99. That was before the dot-com crash. The second time was during that dot-com crash. You got to think about price to earnings multiples. You have the price, but then you also have the earnings side. Once you hit 2000, 2001, that's when earnings started to drop. So the multiple goes up even though asset values are going down. This is typically when you get a spike in PE multiples. It's actually not because prices are going up, it's because the earnings are going down at a really rapid rate when there's a recession. So that was a recession there. Then you have a normalization down to 16, 17 times earnings in 2006. Then you hit the great financial crisis, 2008. You start to have this spike in price to earnings multiples. But then again, things normalized by about 2010. This next spike is during COVID. So again, earnings dropped like a rock in 2020, but it only lasted a few months or a few quarters, and then things normalized again. But if you look at this trend from 2011, price to earnings multiple of the S&P 500 was about 14. Today, that is more than doubled to over 30. So a big reason for the stock run up over the last 10 years or so is because of multiple expansion. So multiple compression alone, price to earnings multiple is coming down, price to sales multiple is coming down, could drive the market lower. That's what we're seeing today, I think, with the uncertainty. Earnings haven't changed in the last 24 hours, but uncertainty has. That's going to cause those multiples to come down. So what is that uncertainty? February 1st, so this is Saturday. This was when things started to kind of move into chaos mode. President Trump announced that there's going to be 25% tariffs on goods from Canada and Mexico, with an additional 10% tariff on imports from China, and then energy sources from Canada, so a lot of oil is imported from Canada, a 10% tariff. When those tariffs were announced, then the countries that are involved, Canada, Mexico, and China, some of them at least announced that there's going to be swift retaliatory tariffs. So Canada, for example, said that they were going to put tariffs on $155 billion worth of goods coming into Canada from the US. That would happen starting on Tuesday, with another round of tariffs that would be happening in about 3 weeks. Now, we just wanted to highlight the energy piece of this, because energy could potentially play a big role in these tariffs and what happens in the future, especially to the economy. This is imports of Canadian crude oil and petroleum products into the US. You can see that this has been rising for decades at this point, but in 2023, and this is the most recent data that we have from the EIA, 1.6 billion barrels imported into the US. That is a ton of oil that's coming into the US. A lot of it is coming from Alberta. It actually gets refined in the US and then either gets consumed here or exported around the world. Here again, energy markets are going to be important to watch because crude oil futures are already up on this news. You can go to the CME quotes right here. This is as of about 9 o'clock Central Time on Sunday night. And you can see that near-term futures, March futures, up about 1.4%. Wouldn't be surprised to see those move even higher over the next couple of days, depending on what happens with these tariffs. But if the cost to import oil from Canada, from Mexico increases, that's going to mean that prices are going to go up for oil overall. That's going to impact the economy. That's going to impact the energy sector. And these are all things that investors are going to have to grapple with. Again, increasing the uncertainty. So let's talk about a couple of things that could happen from the corporate side, why stocks in particular are down. Tariffs could directly make certain goods more expensive. If that's the case, then companies have to decide what are they going to do. Are they going to eat that increased cost? That's going to impact their margins and their profitability in the future. Are they going to raise their prices? That's going to potentially impact their growth. Or are they going to move some of their production onshore? Maybe that's a good long-term move, but short-term, that can cause pain in a business, increase your expenses, increasing your capex, all kinds of second and third order effects by moving your supply chain around. But these are the kind of things that investors are going to start thinking through, especially now that we know that tariffs are going to be put in place. What is the direct impact? And then what are those second and third order impacts that we maybe aren't anticipating to hit this quarter, but will be impacting earnings 2, 3, 4 quarters from now? So you can see why all of this is just adding uncertainty in the market. And where we are today, valuations for most stocks are extremely high. And if you're a stock, let's take Nvidia, for example, that's trading for a price to earnings multiple. So let's take Nvidia, for example. Nvidia has a price to earnings multiple as I'm recording of 47.4, forward PE of 30.6. But the enterprise value to sales multiple is almost 26. These are really high multiples, and the business has been doing really well. But one of the reasons the business has been doing well is their new chips are much more expensive and they're able to charge a much higher price. That means that margins have increased dramatically over the past few years. I'll just add operating margins in here. Look at how operating margins have gone from 16% in 2015 to 63% over the past 12 months. If you add tariffs in there, and there's tariffs on goods coming from Mexico, some of their servers are coming from Mexico. We could see tariffs coming on goods coming from China, from Taiwan. Potentially, you have an impact on the cost side for Nvidia, and these margins could come down. What does that mean for profitability? What does that mean for future growth? What does that mean for competition? All of these things are going to be assessed. All of these things are going to be rethought over the next few weeks, and that's why valuations are coming down. I don't think this is a reason to panic, but this is a reason that I have been buying very reasonably priced stocks recently, stocks that have big moats or are growing really quickly, or in some cases, companies that are buying back stock at a really, really rapid rate because they have a ton of cash flow. I think it's time to be a little bit more conservative. Now, if the market starts to drop, that's when I'll start to get more aggressive. But over the past few months, I've been much more conservative, and it's days like this that I was concerned about with uncertainty coming into the market. But hopefully that gives a little bit of context. Like I said, if you are interested in the stocks that I'm buying in February, that will be coming out to my premium subscribers on asymmetric investing, both here on YouTube and on the newsletter on Monday morning. So I'd love to have you join that community. Let me know if you have any thoughts or comments in the comment section below. Don't forget to subscribe. Thanks for watching, everybody. See you here next time.